Let's talk mortgage payment. There are 4 key components to a mortgage payment: your principal payment, your interest payment, escrows, and mortgage insurance. Let's dive into these one at a time. So what is principal? Whenever I say the word principal or principal balance, what we're talking about is the balance of your loan. For example, if you bought a $400,000 home at a 5% down payment, the balance of the mortgage or the principal would be $380,000. Every month when you make a mortgage payment, you're paying down your principal balance. So what that means is that $380,000 loan amount is getting lower and lower and lower every single mortgage payment you make. Now let's talk about interest. Interest rate and APR are 2 terms that you're going to hear when you talk to a lender about what their rate is today. The interest rate is the direct thing that affects your mortgage payment. So if I say interest rates today are, just throwing out a number, 6%, and APR is 6.25%. 6% interest rate is what determines your payment. APR takes the other fees associated, the closing costs and things associated with the loan, and creates a percentage out of it, adds it to the interest rate. I think it's a very confusing thing. But what you should know is that the higher the APR is, or the bigger distance it is from the interest rate, the more fees are associated with that loan and getting that rate. So if you had a 6% interest rate on a $380,000 loan, your payment for principal and interest total is always going to be $2,270 a month. That piece of your payment is never going to change. Within that payment, you're paying principal, meaning you're buying your loan down as part of that payment, but you're also paying the interest on the loan. And that ratio changes every month as you pay it down. Next is escrows. So escrows have 2 pieces: property taxes and insurance. Property taxes, you can look up the tax rate in the area that you're purchasing. For example, if you're buying a $400,000 home and the tax rate was 1%, you'd be paying $4,000 of annual taxes, and that breaks down to $333 a month monthly that you are escrowing to go to your mortgage. Another way to think of escrow is think of it as a piggy bank. Whenever you hear escrow, just think piggy bank. In this case, a piggy bank is sitting at your loan servicer. You're paying into it every month as part of your mortgage payment, and it's going to pay out every year whenever taxes and insurance are due. So homeowners insurance is also part of escrow. This protects you if you ever have lightning strike your house, or your hot water heater explodes and throws water over your walls like a diva. You use your homeowners insurance to help make those repairs. That is different than mortgage insurance. Mortgage insurance is what you pay monthly if you're putting less than 20% down. A lot of people come to me saying, I have to put 20% down because if I don't put 20% down, I have to pay mortgage insurance. Mortgage insurance is a lot cheaper monthly than people think. A long time ago, mortgage insurance always ran in the hundreds no matter what your credit score was. Today, mortgage insurance tends to be very low for people with good credit. So it's really not something to be concerned about, and it allows you to go as low as 3% down as a first-time home buyer, which is super exciting. I hope that helped you understand everything that went into your mortgage payment. Hopefully we'll talk soon and help you buy your dream home.